call me DJ, and today's conversation is really about the speaker that we have. So just a quick introduction, as I'm sure you would have read in the email that I sent out, or the messages. We are joined by Mr. Nirmal Jain, who is a self-made billionaire from India, and he is the head of IIFL, India Infoline, which is a company he started more than 20 years back. And IIFL is a financial conglomerate. So it deals primarily in securities, finance, and wealth, along with other activities. And it's one of the largest brokerage apps in India. So, you can think Robinhood, but think, 20 years back, and then increasingly, increasing that presence, over that period of time. So it's one of the strongest Indian companies that we have in India, and we're really, really happy to have him here. The other thing that I would like to mention is that it's 10:30 p.m. in India. So especially very grateful for him to join in. So that, because I told him that 12 to 1 p.m. is the time that students are free, and he was very much happy to accommodate that. So thank you so much for joining in, and we're really, really excited and looking forward to listen to your thoughts. We're also joined by Professor Shimon Kogan, who is a professor at Wharton. He is teaching the legal aspects of fintech class, not the legal aspect, the aspects of fintech, the fintech class at Wharton, which is Finance 885. And Professor Kogan is also joining in, also not from Philly. So also, thank you so much. He's also not right now in Philly. So thank you so much for taking out the time and joining in, and also inviting your students to able to listen to today's conversation. So without further delay, taking up too much of time already, Professor Kogan and Mr. Nirmal Jain, over to you. Thank you so much for sharing your thoughts with us.
Sure. Thank you, Dhananjay. Thank you for having me here.
Yeah, thanks for the invite. So just in terms of structure, I'm gonna lead the initial discussion, and then we're gonna open up for Q&A. But Mr. Jain, if you can, so thanks again for joining. And I think it'd be helpful if you could kind of share with us the origin story of IIFL, right? Because that oftentimes kind of shapes up the trajectory and the culture of companies.
Thank you, Professor Kogan. So it's always interesting, actually. Now we are in the 26th year of my job. I mean, which I haven't been promoted for the last 26 years. I remain the same chairman of the group. Originally, when we started, we didn't start as a fintech or internet company. We started as an offline company. Mm-hmm. And in 1995, when I started this, the original idea was that foreigners were allowed to invest in India for the first time, and Morgan Stanley had launched a fund, and there were many more to come. And there are 200 companies in India that were accounting for almost about, say, maybe 95% of market volumes. And I thought that everybody's going to set up a research house and do research on the same 200 companies. Why not let me do the research on those 200 companies and sell it for a fee? And at that time, actually, to be very honest, as late as 1995, I had hardly any knowledge or any clue about internet or what it can do to the lives of all of us, and much to mine as well. So we started in 1995, physically printed reports. I used to pay a lot of attention to printed quality, formatting, everything. In 98, 99, when we discovered I discovered what internet is, first time when Hotmail was sold to Microsoft. And so that is a time when we were making about $250,000 of revenue, which about just 8-10 people, which was not bad. We were doing pretty well as a research or a consulting firm. So that was a time when I thought that if you go on internet, we have to do it wholeheartedly. And I had a partner, so he didn't agree with me. He left me, but I was still convinced that I had to forego this $250,000 of revenue that we are making, and we will put up everything free on the website. So we gave an ad in newspaper saying that we are killing our business model, and all the research that we were charging now will be available free for anybody. And we got, I think that ad got maximum response, because anything free in India is really loud. Okay,
people like free, huh?
People like it, and we don't have time. Otherwise, I have to share more stories about how much free is tempting. And then we launched our website. So all those who ask for free research, we just send them the link. And this is how it started. From there on, of course, we remain focused on financial services. But, if you ask me today, it's very easy for anybody who has been successful to stand on a pedestal and say that I had a vision to create the largest or one of the largest, one of the leading financial services companies in India. But I often say that there's a real story and a real story. So many times, the people that you call are, the successful ones. But sometimes it was just the thin edge, where the dividing line between survival and collapse would have been. But we somehow managed to survive. And I say that vision is 80% hindsight, 20% foresight. Because what happens, you keep taking one day at a time. That time, so today we are the largest wealth manager actually, although people still know us as a discount broker or broker in India. And when I started, I had hardly any wealth to imagine that there can be a business of managing other people's wealth. So we come a long way, but we remain focused on financial services, kept on taking businesses as we went along, kept on taking people, absorbing people, building technologies, and so here we are 25 years later.
That's great. So, in some ways, you guys were a fintech company before the term existed, right? So, how did the sort of this phenomenal rise of fintech over the last 10 or 15 years? How did that affect your business? Because I can imagine multiple ways in which it impacted how you run the company and how you change your offerings, right?
Yes, Professor, you're right that we are a fintech company a little ahead of time. So when we started, the whole idea was to democratize information, and which was in 1999 when we changed our business model. In 2001, we launched our broking services at 5 paisa, which is 5 basis point brokerage, when brokerage used to be something like 100 basis points or 150 basis points.
Yeah.
And the idea was that if people can trade online, and supposing I'm receiving an order from Morgan Stanley for 100,000 shares, or I'm receiving an order for 100 shares from Manu Bhai, if those 100 share order or 100,000 shares orders can be traded online with no incremental cost, then brokerage can be the same. And we called it like, we wanted to democratize information as well as brokerage. So we put up a lot of research free, and then we reduced the brokerage rate. And we worked a lot on the online platform because those days, the last mile connectivity was very poor. The mobiles were not there. The internet was on the large desktop, which was still, a little bit of technology. I mean, it was not still as easy for anybody to use it. Having said that, I come to the second part of your question, that how has it affected us in 10 years?
Yeah.
So I'll be very honest, actually. We were a little complacent, and we lost out on a lot of ground to some of the newcomers in last 10 years. And I'll tell you how did it happen. So we started as one of the leading fintech companies in, say, 1999. By 2007, 2008, we became one of the leading in retail broking. That's the time we attracted a good team and started our investment banking, our institutional equities, and wealth management businesses. Now, these businesses were not as digital, were not as internet driven as our retail.
High touch, right?
They are relatively high touch.
Yeah.
So what happened when the second wave of digital technology started, with the mobile becoming cheap, with the smartphones becoming cheap, and internet becoming wider and deeper in India, which was about, say, 2012, 13 or 11, 12. So we were still focusing a lot more on our high-tech businesses of wealth management. We did well there, but that is the time there are many other competitors who got into discount broking, who got into the mutual fund for internet, and they actually in the digital world, they basically went ahead of us. We woke up maybe 2-3 years earlier, which is about 4-5 years after many of these people had already covered a lot of ground. You know what? The way it happens is not that we were not aware. It's not that was not discussed in our management meetings or in our board also. But because there was a business which we had, which was generating good amount of profit, and we were trying to be leader there, that never got the top management attention or the entrepreneurial energy or the allocation of risk capital and the ability to cannibalize your business quickly as it should have. It happened a little later, but that's part of the game. So, it's not that every time you win.
Yeah. So that's so how do you, I mean, it's easy to talk about that, but like as a chairman, right? How do you sort of institute culture of innovation and of sort of self-cannibalization? Because you mentioned that word already a couple of times, right? And it's I can only imagine how difficult it is to do in a company that is A, successful, B, been around for a while, right? And has sort of set ways and a set sort of even political power internally, right, of decision making. So how do you
It's honestly, it's not easy because when the company becomes larger, most of the people, the senior people, they have a profit center, and regardless of what happens, they want to protect their profit, and because their bonuses, their incentives, their stock options are all dependent on that. So one thing, what I believe is that the risky decision has to be taken by the entrepreneur, because you're the largest, say, individual shareholder, and you have to have courage to do this. That is number one. Number two, you have to encourage and to change the reward scheme and that we have done always is putting more emphasis on long-term stocks and stock options which are vesting over a period of time. You have to articulate your decision, and your thought, and listen. Sometimes, what you want to jump into may not be the right thing, but the best idea has to win. And the culture is very important. Sometimes you'll come up with a situation where there are people who are very rigid. Then you have to have a golden handshake and let them go. And because this for the sake of larger good, for the sake of good of the organization, and so these are difficult decisions. But the culture is something once you set, then it becomes all pervasive. It has to start from the top, and then there are many people who really want to take risks because they look at, say, the stock options over 5 years, and not the bonuses and cash that you're going to get quarter after quarter. And that is where also one more thing helps is a good amount of interaction with people, maybe from academics, people like you, or people from peer group, or people from technology companies outside your space. They've done something very innovative, very courageous. And so, I mean, there are multiple things that you need to do, but what you need to focus on in one word is culture. Culture of risk-taking, culture of innovating.
And to what extent do you think that in a large organization that can really happen, versus something that ultimately a lot of it will be sort of bought or imported or collaborated with? I mean, basically, where I'm leading with this is kind of, again, sort of fairly generic dilemma for other financial service companies, but like, how do you manage that process of deciding what risks to take in-house versus what technologies or companies to buy, collaborate with, etc. So do you have sort of a set philosophy, or it's sort of more ad hoc on a kind of?
Yeah, we learned a little late, and it took some time. But what we discover, and what my very strong view is, that however large a company you are, the innovation that you can have in-house is very, very limited. Because, like, if I had to quote Newton, then if the entire innovation is like all the sand on the beach, then what you can do internally is one grain. You can't do. So you have to have a culture of partnership and alliances, because no amount of resources, no amount of capital can match all the innovation that can happen. So like there are 60 people here in this group. What all they can think and innovate is neither you nor I individually can do. So what we have started doing is that partnering with, at the same time, what happens is that there are so many innovative ideas and so many new fintech companies and possible alliance partners that you have to choose. And because you can't partner with too many people, it becomes unwieldy. So to figure out that where your, there's a call that you take, that where the biggest gain versus easiest to integrate and cultural matches. And what we started doing is that we also started investing in some of these companies. So wherever we want to, say, have some partnership with fintech partners, alliances, then we take equity stake. We also got into an alliance with Google and the GPay platform. So I think the possibilities are infinite, and this is a very new thing that is happening in today's world, is that everybody will have to partner and have alliances, because everybody is doing. There are many people who are doing certain things very, very well and very innovatively, and they got that niche expertise which you really don't have to build it yourself. So depending on how the ecosystem is, but there'll be many opportunities to partner, and that culture is very important for any large or any organization that wants to grow rapidly.
Right. That's interesting. So I learned recently from actually one of my from one of my TAs that there's now a direct flight from Bangalore to San Francisco, right? Which sort of to me suggests that there's probably more flow of ideas and capital across these two very large innovation hubs. Do you see this on the ground? Like, do you see this sort of affecting kind of the innovation speed and maybe the scope that we see in fintech?
So some of the companies have offices in San Francisco as well as Bangalore.
Mm-hmm.
I mean, maybe they put more programmers here. And so I think in today's world is all very interconnected world, and everything is combining very seamlessly. Like say, I'm talking to so many people here on Zoom, and maybe a little while ago, I was talking to somebody who's just about 200 meters away, also on Zoom.
Yeah.
And it really, but what we have seen that as far as we are concerned, that there are more Bangalore companies that connect with us. But of course, there are companies in San Francisco. Some time ago, we were talking to a company in Israel also. So, but the fact of the matter is that San Francisco and Bangalore, there are many fintechs. Say they are funded by US companies. So there's some office here, there's some office there. It really, I think it's a very interconnected world. So it really doesn't matter. So I don't think there's any dichotomy. We just talk to all of them, and wherever the best idea or best fit, that is what we try to look for.
Right.
But there's not much difference today in terms of the cost, the structure, or the way people work. It's just becoming one world very quickly.
Right. No, I mean, so part of what I'm sort of asking with this is, and so we see some large companies, right, in the financial service space, part of the sort of the fintech companies moving across jurisdictions fairly well, right? Do you see this, like, do you see these new breed of companies? So think tech and financial, right? Take some of the large neobanks that came out of Europe. Do you see them eventually sort of becoming international players? And in that context, what are some of the interesting trends that you see with respect to regulation, right? I'm not talking about the global regulation, but maybe in India, given that it's a very large market.
So regulations are evolving. Fortunately, in India, regulations are moving in right direction and very rapidly.
Okay.
And COVID has helped in that. And so India has come up with something called DEPA, or Data Empowerment and Protection Architecture, and which is very interesting because there are so many people who are financially excluded and they don't have access to, say, the formal financial system for loan or investment products. And when they approach fintechs and they are very aggressive in taking data, sometimes they can scrap the bank statement, they can take the password. But under the leadership of Mr. Nilekani, there's an organization called iSpirit, and they have developed a policy which has got support from the government, where they're creating a consent-based architecture where a granular data, which is a revocable consent and only for a limited purpose, and is auditable. So I think that works very well. Also in India, we started something called DigiLocker, where all your financial records, all your medical records, all your educational records can be in one government digital locker. On a mobile or everywhere, you can just do a checkbox and give consent. The advantage is that data is always authenticated. You don't have to worry about whether the data is fudged or fake, because it's coming straight from government, and can be also, because digital, can be analyzed instantly in a fraction of a second, and your decision to give loan or recommend can be very, very seamless. So, and India's Aadhaar, which is, so what they've created, they call it India Stack. So they created Aadhaar, which is your biometric identification with your thumb impression and iris, eye scan, which works very well. With that, all the data is linked. Your income tax records, your GST records, your health records. And so you have a identification layer, which is Aadhaar. Then there's authentication layer, which is e-signature. Then there's a content layer, which is your data consent layer. So it's becoming a very nice technology infrastructure which is getting support from government, because regulators are changing regulations, they're coming up with new policies. I mean, a private entrepreneur will say that everything should happen tomorrow, but then you can run into a lot of difficulty.
Yeah.
But getting to understand that, okay, it's a large country and a large system, and the bureaucracy has its role to play, and you have patience, then things are moving pretty quickly, I would say.
Yeah, no, it's actually, it's amazing. I often cite when I teach fintech, I often cite exactly this infrastructure layer in India, because it's amazing, like how quickly you can get fintech adoption once you have these rails, basically, right? If you can establish identity, if you can share data, it's phenomenal how quickly fintech adoption happens. So you mentioned the COVID. So COVID, of course, had many implications on fintech companies in the US. Mostly positive, I would say, at least for valuations and for user base. And we've seen some scandals, of course. What did it look like in India? Well, like what was the effect on IIFL?
So while COVID has caused a lot of damage to lives and health, so obviously we pray that we get over very soon. But still, the fact of the matter is that it turned out to be a huge booster for our business, and we saw tremendous growth in financial services. Now, first is what it did. So it accelerated the adoption of digital technology by people who are still maybe lazy or maybe not moving, inertia, which are not letting them get into this. But when you have no choice, you are stuck in your home and you do things. Obviously, you get onto your mobile app or computer and do it.
Right.
So the digital adoption, accelerated very rapidly in India. A lot of innovation started happening because people realized that, okay, you can work from home and you can be even more effective, and you can probably your productivity can be better. Government also promoted, by reducing the charges, allowing certain things which they were a little skeptical earlier. So a lot of innovation happened. Now, from financial services point of view, something which was not expected earlier, something which was not intuitive when the whole COVID lockdown began, is that now there's a global liquidity has become very benign. Because everywhere the central government, the central bank and government, they're printing money. And money is like water. It finds its way. And so that is one. And on the other hand, if you really look at the interest rates in developed world, almost $20 trillion of bonds today have negative yield. Obviously, people don't have a choice. So even if you want to put slightest small part of your portfolio into risky assets, or where you hope to say make 10-12% dollar returns, then India and China. And China, for a variety of political reasons, people are being skeptical. They are saying we have to have a policy of China +1. So India became a huge beneficiary of that. India attracted a lot of foreign capital. On top of that, as at least the upper middle class and the HNIs, the expenditures came down, savings went up, people became risk conscious. There many people were at home, they had nothing to do, so they started trading. All these factors converged, and we saw a huge surge in new customers, volumes in terms of our broking business, or even in our wealth management. We saw that HNIs also, the deals that they do with selling their businesses accelerated. A lot of wealth was created. In our finance business also, we saw that we can bring down our expenditure significantly and still work on the credit with the support of government, because they introduced like a sort of a credit guarantee scheme and few other things. So all these things helped our business, and it has been very, very extraordinary time. And what we are thinking in March is a doomsday. In April, May, we realized, oh my God, it's a boom time. And so we have to change track very rapidly, because on one hand, you say, okay, I'm going to cut salaries, reduce people. Within 30, 45 days, you say, no, I was wrong. And that is how you communicate and, get over it.
It's amazing. So maybe the last kind of big picture question before I ask you a couple kind of more questions that are more micro to the life of the audience here. But the way I view it is like trust is a core element of delivery for financial services, right? And we obviously see this emergence of new players that no one heard about only a couple of years ago across all areas of financial services. So my question is, do you think that do you see technological innovation reducing or actually increasing the trust capital that established players have? Because to me, it's a really interesting question, right? I mean, basically the intersection between technology and technological complexity and trust.
Yeah, Professor, I think it's a very good question and a little complex one to answer also. So there are divergent trends, and we really need to understand how the whole thing is working. So there's one segment of customers, there are new millennials, which are, and in India, 60% of people are less than 35, 36 years of age. Even in workforce, predominant force is still like young.
Mm-hmm.
Now, these people have a little different view of the world and the way they look at trust. And people who are a little older, basically, they prefer established players and names. Now, these new millennials, who are also the new set of customers, they basically will rely a lot on Google Uncle and not on their real uncle. And they'll do their own research, they'll understand the technology. And that is where some of the fintechs have built that. Okay, so in digital world, there are a lot of innovation that can happen. So suppose you are doing investment, we can say that your depository account is with the regulated entity. We are just giving you the advisory service or building your portfolio. Okay, so the new millennials who are just on internet all the time, they basically like it and they understand it, or they understand the charges versus whatever is they're on internet. It's very different world. So like supposing my generation, there was okay, I'll give you an example of supposing a good banker who's been servicing my dad. He'll always think that it's good manners to go and see him once a month or once in a quarter, or pick up the phone and talk to him and say, Mr. Jain, how are you? And how are your children, how's family and everything.
Yeah.
And now maybe my daughter, she will have a completely different approach. They'll think if somebody's calling up, she gets bugged and she says that is like intrusion in privacy. Why don't you leave me on to my own? If I need, then I'll reach out to you. So we have two sets of customers that have to be dealt with differently. Having said that, the trust matters, and therefore we spoke a little earlier about partnership, that becomes even more relevant, because there are many fintechs who are innovating technology, but they don't have a base of customers, and they really can't command trust overnight. And the smarter ones, rather than trying to do everything on their own, they come and do an alliance with somebody like us who got 4 or 5 million customers, and we can reach out with the advantage of technology and without compromising on trust. So I think this question is really good, but a complex one, and there are many things that are sort of working in this direction.
Yeah, that makes sense. So let me sort of conclude with two advice questions to the audience, right? I mean, so everyone here, or most people here, are here because they are investing in their human capital, and I'm trying to help them do that. What would you kind of view the most important skills? And I'm kind of deliberately keeping it open. But what are the most important skills that you would suggest people invest in, if you're now in your 20s, early 30s, looking into the next 20 years of your career?
So maybe I'll talk about two things. One, which was always relevant for me, or even 500 years ago also, and one which is a little different and new. So one is the interpersonal skills, or your ability to get along with people. Mm-hmm. So even if you're in a technology world, remember one thing, that if you want to become an entrepreneur, you want to work anywhere, you have to work in a team. And so, your ability to listen to sometimes things which you think are stupid, or not the way you think the world is, or the way things should happen. I'm worried about this generation, that many of them are so much on social media, internet, that they are almost sort of not able to, people of my generation probably will look at your face, your eyes, and say, and they will understand what is there in your mind, or would probably like to talk and meet. And with COVID has even more isolated people, because work from home, everything has become. But I think that this will not go away. because there's so much to human interaction and working in a team that you should not. And you used to have a course when I did my MBA called Organizational Behavior, which I'm sure is there, maybe different names, which is people used to think this is like useless, but maybe 30 years later, I realized that was one of the most important courses. You know what happens? Many times you may or may not have certain skills. You'll be able to hire those people or make them partners if your understanding of human nature and your interpersonal skills are good. Like in India, there's a very successful entrepreneur called Anil Agarwal, who's almost a school dropout. But his ability to hire people much smarter than him in all functions, whether it's a finance or a metallurgy, is so good that he's built an empire, which is one of the largest steel companies in the world. So never never undermine that. That is one. The second new thing is, which I want to talk about, is knowledge, or keeping abreast with everything. So you have to have basic understanding of data science, machine learning, and what is happening in the world, because everything is changing so rapidly. Maybe 30 years ago, 50 or 40 years ago, world was not so volatile. So people, even supposing you take an example of doctor, if they passed out of the medical colleges, at least my family doctor, he would not have opened any book or any research journal for 30 years, but still he can treat patients. But in our business, which is fintech or financial services, things change so rapidly that you have to have habit of continuous learning by reading, talking to people, or attending seminars. And of course, there's always a trade-off in time. But knowledge will be very, very important because it's changing so rapidly.
Great. Not to plug in my fintech course, but that's exactly what how I'm designing what this course is designed to do. So my final question is, there are current and future entrepreneurs in the audience. You've obviously been an extremely successful entrepreneur. What advice or what recommendation do you have for them?
Okay. So one is, I'm successful, but there are many, many millions of people more successful than me. So whatever I share is my experience, but obviously you can validate or you'll develop your own formula for success. One is that when you build a business as an entrepreneur, look at the customer and something which is unfulfilled or unmet need of a customer, and figure out whether you can do it better than others because of either your technical skills or your passion or your experience or whatever way you're dedicated to. And that is how you'll create your moat. If you try and chase valuations and say that, okay, what investors will like, I think we'll be on the wrong path. So rather than looking at what investors will like, where will I get good valuations, where will I get my $1 million or few $1 million, that is not to be the driver. And even if in the short term that looks very tempting, that will take you on wrong path. That is about how do you look at a business model. And once you're into a business, as I said, that you have to be always alert and look at, so maybe I put it as 4H, so I use the letter H to make it easy to remember in terms of whatever I learned. So the first is that as an entrepreneur, hunger. And of course, what famously said that stay hungry, stay foolish, but hunger is important because you have to take risk. And I've seen that many successful people, the richest man in the world, or one of the richest like Jeff Bezos, or in India, Mukesh Ambani, they're still hungry. It is not that they need money, capital, or anything, or even fame for that matter. So if you're an entrepreneur, you'll have to be hungry, and that is why I'll take risk. And a risk will have to be taken by you. The second H that I talk about is humility. World is changing very rapidly. If you're not humble, you'll not learn. You'll not correct your mistakes. However, anybody will make mistakes. So if you think that you're not made mistakes, means you're not discovered enough what you've done or not done.
Yeah.
So you have to be humble. And as my father used to say, that when there's a flood, the coconut tree on the shore will fall, and the humble grass will just bounce back to shape very quickly. So you have to adapt, because the environment, everything will change. Whatever your assumptions about market, about customers, about competition will change rapidly. The third H I talk about is basically hard work. And that is something which, again, I don't think there's any substitute for that. But if you love your work, then, as people say, that choose a job that you love, you don't have to work a day in your life. So, for us, like, even I'm talking to you at 10:30 or whatever be the time, it's not that you have to have time for your family, you have to have time for your personal health, but still your passion should drive you. And then hard work is something which is always part of the game or part of the success story. And the fourth H, which is very important in today's world, much more than ever before, is honesty. And any cutting corners, whether you are to investors, to your customers, to your stakeholders, to your society, just don't compromise on that. It's a world of Google, something that can never be erased. Your lifetime is too short to delete it. So be very, very careful. And many challenges will come, in your career, in your business that you do, that you'll have a choice. And however bad or hard it look, but choose the honest path. That will always be better for you.
Thank you. That's great. So I have plenty of other questions, but maybe DJ, you wanna moderate the Q&A, and if there's time then left, then I'm more than happy to ask Mr. Jain more questions.
Yeah. Firstly, thank you, Professor, and thank you, Mr. Jain, for your thoughts. This has been a great session filled with a lot of great quotes. The one about the sand grains, the one about the coconut tree, and I've been noting all of them down and putting them separately, as I'm sure the audience is as well. And we've also had a fantastic turnout. We would have been able to fill up an entire Wharton classroom in case we were able to do this live. Unfortunately, I mean, we were able to do this in person, but this also works. So we have a lot of questions. We have actually 10 questions that have come in, which is as many as Professor you have asked. From students. So I'll try to take them one at a time. Mr. Jain, if you can answer them briefly or in detail as you'd like. The first one.
Yeah, let's do. I'll try to be a little brief, and so that probably we can cover all the questions. Yeah.
Okay. So the first question that we had was from Rishi Palan. He said that what needs to be done to encourage retail investor participation in India? Is educating a barrier, and what do you think needs to be done to improve this?
So I think all barriers can be removed through technology and digital world, like education. So lots of free education material is becoming available. Wherever there's an opportunity, there are entrepreneurs who are coming up to fill that gap. So what needs to be done is, I think the whole environment, the regulatory environment, the financial world is on the right track. And what government can do is basically encourage the innovation, and also the wherever possible, they can probably incentivize. And Indian government has been trying to do that. The small investments, small retail loans, by giving them tax advantage, removing the charges, removing the costs, that typically banks can charge. And other than that, I think education is already happening. The faster the technology and smartphones become available, people are learning on their own. So let it go its course. I mean, it's on right track. Don't disturb it. I think things are happening as quickly as one could imagine.
Right. The second question that we have is from Franz Rasman. I'm sorry if I'm mispronouncing the name. It says that, do you think IIFL, Robinhood, and other brokerages have a responsibility to protect individual investors, or is it enough to say that we're democratizing finance and leave it at that?
It's a very good question. So no, we must understand that it's a capitalist world, and between two, you have to choose the lesser evil. Okay, so there'll be speculations, and some people burn their fingers. But at the same time, the alternative is basically that put restrictions. Then what will happen is that it will not spread, and there are many people who could benefit. It will not happen. I often take an analogy of accidents and the road accidents. Okay. In India, you'll be surprised. Of course, India is, doesn't have a good distinction for that, but 300 people get killed in road accidents every day. Okay. And I'm sure world over, thousands of people must be getting killed, or hundreds of thousands of people must be getting killed every year. Now, can we make the traffic and the rule for road so tight that, of course, nobody will argue that human life is more important than financial loss? But the world has very unconsciously, inadvertently taken a choice that, okay, some people will get killed, but still transport is important and we have to allow it. We can't make the traffic rules and signals so tight that, or maybe put the barricade. People can't the transport becomes difficult. So the fact of the matter is that we allowed human lives to be lost every day for transport. So in financial services also, stock market by nature is speculative. And of course, people can learn from experiences and put breaks and checks and balances. But in capitalist world, there'll be cases where people lose money. There'll be speculation. But on the you'll have few cases like that. But there are many more people who will benefit from this. Like you take India's context, and there are many people who would have built a house with this, got their daughters married with this. So regulatory environment has to be vigilant, but you can't stop it. And honestly, I don't have a solution to make it 100% foolproof. There'll be some casualties, some accidents. We can try to reduce it, but we can't get over it.
Got it. The next question that we have is from another Wharton student called Priyanka Krishnamurthy. Priyanka asks that, what are your thoughts on the interplay between digital data infrastructure and data privacy standards?
It's very good, actually. It's a challenge which I think for many years regulators will, and the researchers will have to deal with. But I think what India's the DEPA, DEPA, you can go to a website and do some work on this. There are a lot of policy papers on data empowerment, protection architecture. India's Niti Aayog, which is the planning commission of government, has also endorsed that. So, what is happening? Supposing that I'm a small businessman in a small town and I need a loan. Now, what will happen is that I'll have to say, okay, I don't have a credit history. So if I go to a lender, he will basically ask for certain details, which may be how many times I bought from Amazon, what kind of restaurants I eat, what is the number of check bounces in my this thing. And if I share that data, knowingly, I get that loan may be of much more value than the risk that data causes. But the moment you allow this, the hundreds of thousands of people who can share data like this, some of them can be misused. So the fact of the matter is that there's merit in sharing data so that people can allow you to do certain financial transactions, and there's a risk. So the way DEPA has been evolved in India is, I think, very good. It's a brilliant model where they created a layer in between. They said there is one set of financial information provider, one set of people who are financial information user. In between, they'll keep the data in a vault or in a lock kind of locker, which is safe. And every time there's a consent, only that much of data goes to the user, and only for that purpose. So I think that is the best, at least what we can think of at this stage, but maybe people will come with more innovative solutions. But there's a trade-off, and we'll have to allow some bit of data sharing, for financial inclusion. There's merit in that. And at the same time, you can't ignore the risk.
Got it. Thank you. The next question that we have is from Akhilesh Kumawat, who's also from Wharton, asks that, with the rising influence of social media speculation on stock prices, say the GameStop stock, do you think that new techniques such as artificial intelligence, natural language processing have real potential to tap value from speculative buying?
So, no, I'm saying your question is that they have value in doing speculative automated buying.
So the question that he asks is that there's a lot of influence of social media speculation. And so how do you see new technologies, artificial intelligence really playing with, social media speculation and stopping that, or maybe enhancing that?
It's not easy at this point in time, but it will happen. So every time there's a GameStop, people will try and stop and understand what the game was and try to find solution for that. But as I said, that in a capitalist world, there'll be bankruptcies, there'll be losses, and there'll be risk. And there'll be people who will make a lot of money, there'll be people who will lose a lot of money. But still, we don't have a better, superior alternative. So what has happened, that social media, these are, actually, all these things are happening for the first time in human history, and we are all learning. But the good news is that there are a lot of people who are, working on artificial intelligence and machine language, how to prevent this. And even regulators all over the world are investing in machine learning and data analytics and artificial intelligence to say how to prevent. So it's become like a game which never stops. And every time there is an accident like this, people will learn. People will go back and say that what solutions we can have, and the enough innovative, intelligent people will find solutions. So I think today what we are compared to say 20 years ago or 50 years ago in terms of financial regulations and risk, we are much better off because regulators are learned, governments are learned, people are learned, and we can still get better. But I think it's a continuous process.
Got it. Thank you so much for answering. The next question that we have, and I'm sorry, and please feel free to. I know these are a lot of questions, and it's almost like a rapid fire.
Yeah.
So I apologize. But the next question that we have is from Aishwarya Mahapatra, who's a second year Wharton student. She asks that we heard a little bit about the difference in access and internet infrastructure earlier. So in India now, it's the millennials, especially in tier 2 and tier 3 cities, who seem to be driving the growth in individual investor segment. Would be great to know how traditional trading brokerages such as IIFL can compete with new companies to target this market segment. So she's talking about tier 2 and tier 3 millennial investors.
So tier 2 and tier 3 millennial investors in last since COVID, we have seen a huge surge. And good news is that tier 2 and tier 3 in India are growing rapidly in terms of the economic progress or net economic value. And we are seeing that very large number of investors are coming from there. In terms of traditional brokers like IIFL, because they got their brokerage rates are higher, which are on a ad valorem, not a flat fee, and their customers that they are servicing offline through branches, through their relationship managers. Obviously, that entails higher cost compared to say discount brokers who have no branches, no relationship managers, no people. Everything is do-it-yourself kind of thing. The cost structure is much lower. What we have done, and everybody will have a different strategy for that we have another company called 5paisa, which is also the same promoter group company. So we basically, to meet with this challenge, we broke our group into 4 listed entities, because every business has a different culture, different technology requirement, and different way the business can grow. So we set up a new entity, 5paisa.com, which is discount broker, which has got 1 million customer already and is growing. So we are trying to service different segments of customers with completely different corporate entity, which are siloed with different set of people, different culture, and different capital allocation.
That's very interesting. In fact, I recall while reading about IIFL that 5paisa was one of the starting blocks on which IIFL was built. It's interesting how 5paisa is taking a new turn.
So we have now 2 broking companies in our group. 5paisa is a separate entity. So both are listed.
Yeah, no, that's very interesting. We have last 3 questions, and then maybe if Professor Kogan wants to ask one, and we can call it a day or actually a night. The question that Kushal Sen from Jaipur asks that he thanks you for the session, and he wants to understand what your perspective is on India's bullish run on growth and global development indices. Basically, he's asking about the impact of COVID on the Indian economy. If you can just maybe give your basic thoughts on that.
Okay. So, India by nature, I mean, this is what my perception is, will act very well in a crisis. So faced with a crisis, they'll do much better than under normal circumstances. So there was one crisis in 1991 when our foreign exchange reserves had dropped to almost like $1 million, which was just about 1 day's need. And at the time, major reforms happened. And we saw that the economy grew very rapidly after that. 30 years before 1991, economic growth averaged 4%. In 30 years thereafter, it averaged more than 6%. So in 1991 was one big tipping point when the duties were cut, so many reforms happened, and the economic growth accelerated. Again, with COVID, what we have seen now, and the latest budget has done the same thing. So I think India is very well placed to grow very rapidly now. The economic growth can be in double digit now because the COVID has forced government to basically take many reforms that were pending for a long time. And that has also given an opportunity to the government to spend a lot more without worrying about fiscal deficit, without worrying about inflation, because when you're recovering from crisis, inflationary fears are lesser. I mean, that's a subject matter of a different discussion. But so all these things put together, I think India is on a roll. And as people have discovered that they can't be overly dependent on China, They want to have China plus one. The government is very pragmatic in terms of supporting Make in India and manufacturing setup here along with services. All these things put together, India can attract very large capital. The domestic savings are also very good. I think next 10 to 20 years, India will be a great place in terms of the economy.
Thank you. Just last two questions. We have a question from Gabby, who is a Wharton first-year student, and she asks that, what do you think about the future of identity, and how can other countries leverage the financial identity technology used in India that you spoke of? Are you bullish on other countries doing something similar to what India has done?
Yes, I think a lot of developments are happening all over, and I think India, surprisingly, and which is not intuitive for most people to imagine, has leapfrogged in technology very rapidly. Identity, Aadhaar. I think, see, look at this way. If the face recognition technology is working, and why should you need anything? You should not need a credit card. You should not need a purse. You should not need an airline ticket. You walk into an airport, your face is recognized, and they know that what kind of, if you're really identified, verified person, you can walk through without security also. You don't need boarding pass. Automatically system recognizes where are you headed to. You want to make payment. You stand in front of computer or a camera. Your face is recognized. Automatically your bank account is linked. You can put your thumb impression or just smile to consent, whatever. So these technologies are going to happen very rapidly, and that will basically help the world in every respect. Whether it's, and from your face, your medical records, your financial records, everything is there. So things are moving in that direction. But next 10 to 20 years, I think we'll see amazing things happening, and which are not difficult to visualize today.
Got it. Thank you so much. And the last question that we have is from Akhilesh, who asks that currently the US has a 2-day trade settlement period, which led Robinhood to curb trading. In your opinion, is it possible to have real-time trade settlement? And if not, I mean, if yes, then when do you see this happening?
This will happen very quickly. Actually, technologically is very easy and very simple. Uh, the system is a little different in India as compared to the US in terms of securities settlement. But what has happened is that now broadly securities are already dematerialized. They are like bank balance in your DP account or depository account. They can move simultaneously with the money. I think it's just a mindset issue, because today in terms of technology, stock exchanges, the securities world is ready for a real-time settlement, and which obviously can prevent many of these kind of speculative uh, sort of games which are played, and sometimes the speculative squeeze or whatever we do in that 2-day time period that you get, that can be removed very easily. I don't think it's a challenge today. Even our institutional, everything can move seamlessly. So your bank account already, in India, there is something called ASBA. A lot of, so many times regulators also want to go step by step. They are used to certain way of doing things, but IPOs can happen seamlessly in just at one click. You open the IPO, who want to bid, they put their bid, and automatically the allotment happens. The transactions and the securities and money can move seamlessly. Technologically, is not difficult at all. It's just question of government and regulatory bodies to be ready to do that. And there will be lobbies of large brokers, very large brokers, very large bankers who will oppose this, because they make a lot of money on float. They make a lot of money on this gap that is there. And obviously people, one day, automatically think of, they'll overcome and these things will happen. Maybe T plus 2 will happen, T plus 1, and then T plus 0 kind of a thing.
Very interesting. Professor, it's all over to you. And thank you so much, Mr. Jain, for answering all those student questions. Professor Kogan, if you can.
Yeah, so I'll maybe ask a couple, and then I think we can call it Jen has been answering lots of questions in succession, but like just to follow up on that kind of settlement question, it sort of naturally makes you wonder about blockchain, what role it has to play in this context and sort of more broadly in financial services. I mean, so it's kind of two-part question. A, what's your sort of personal view on the role that blockchain has in removing frictions? And B, I mean, maybe you can kind of share some initiatives or some some projects that you guys are internally working on around blockchain, if any? I don't know, maybe not.
No. So I think blockchain is very interesting because when we look at authenticity and automatic confirmation from all the parties interested, I mean, this will basically be very, very important, particularly in financial world. But honestly, in India, I think it still is some time away before people make serious investment in that.
Mm-hmm.
So we also not invested in blockchain directly or in any serious way. But what we are working on is that we are trying to the business loan aspect where you do the discounting of trade receivables or you give loan to a small enterprise and connect with the bank or you create a platform where the raw material supplier and their customers all can come together.
Mm-hmm.
So there are some fintech companies that are working on this. We are trying to work with along with them. So work is going on this, but nothing serious in terms of investment or in terms of a blockbuster idea of using blockchain. But I'm sure that in next 10 years, it may not happen in next 1 or 2 years, but in next 10 years, it will become a defining standard for many financial transactions in particular, and maybe in other sectors as well.
So you mentioned, a lot of your businesses in the kind of in brokerage business and asset management. We're clearly going toward zero fees or zero commissions, at least in the brokerage world in the US and my understanding also in India. How do you see that playing out? Like, is it going to be essentially kind of the playbook of the US of selling order flow and making money that way, or
So, yeah, interesting, because that's what I said, that India, you can't sell the order book or aggregate the order and like what say Robinhood is doing, they may pass their orders to Securities or some aggregator like that and make a part of that. That in India is not possible because of screen-based trading with one clearinghouse for all. So trades basically get matched on the screen and there's no aggregator as such.
I see.
And in a way, what is being done there is not good because people who are buying these aggregated orders have advantage of information which can be misused. But I mean, that's a very little complicated subject. But there are different ways to make money. So what happens that once you have a relationship with a customer and the brokerage is free, but he buys many other products from you. So he buys insurance from you.
Yeah.
And once you know his behavior, he may need a loan sometimes, he may need a mortgage, or he may need a personal loan. Sometimes he may be willing to pay for, say, research or some advisory service, or sometimes he may subscribe to a discretionary portfolio management service where you'll have some carry and some fee. So what happens that this becomes a small hook, and which is not difficult. I mean, WhatsApp gives Messenger free, or Facebook, Google searches are free, but then they make money by different ways. So again, this will become a game where what innovation you can do. How to innovate is by using the data. How do you sell other products, and how do you put the right product at the right time so that you get the maximum value out of it. So that is how I think it will be played out.
Yeah, makes perfect sense. So, each of these questions is a multi-billion-dollar question, right?
Yeah.
So anyway, I think that I think we DJ is up to you, but I think that to sort of bring us to that, I see that people are forced to leave.
Yeah.
So Mr. Jain, thank you so much.
And also, Mr. Jain, it's 11:30. It's 11:30 p.m. where he is. It's an incredible testament, I think, to his love for students that he's up this late and answering questions one by one. Thank you so much, Mr. Jain, for joining. Thank you so much.
Pleasure. I really enjoyed. Thank you so much.
Thank you, Mr. Jain. Thank you, Professor Kogan. Thank you, everyone, for joining in. Thank you so much.
Thank you, and have a good day ahead, all of you. Thank you so much.
Have a good night, sir. Thank you.